Hey Nima, you ready to talk some economics and MMT?
Yeah, of course.
Yeah, Dylan and Nima have been really busy. Nima's flying all over the earth all the time. So hopefully he's now stayed and stuck in Florida so he can
Yeah,
eat hurricanes.
yeah. I'm sorry, but these past months have been too much travel, and it's not going to be that bad moving forward. Although for the remainder of the year, there's going to be some, but we're going to make an effort to be more consistent with our schedule.
We're I kind of want to start this Nima with this goofy ass X conversation that we had, or we got roped into, I should say. So let me share this. We've got a couple cheerleaders on X, which I appreciate. This is what we got roped into. So this guy, Dave Green, I don't even know who Dave Green is. Do you?
Nope.
So modern money theory is obviously getting thrown around now, particularly by the left, who, even if we agree that modern money theory is correct and the left might have some good points on it, we still believe the left is completely psycho and retarded. So the place that these people may be coming from, like Dave Green, I understand their heart, but they're throwing the baby out with the bathwater. So let's kind of explore how this conversation goes to, I don't know, we'll get some interesting thought experiments out from this. So this guy, Dave Green, posts this comment saying, the real purpose of modern monetary theory is to convince the elite class that debt is not actually a problem. And he said this in response to this guy. Oh, there's a response to a response to a response here. Somebody originally said, it's troubling how little the national debt features in our political discourse. Washington and the media treat it like it's an anachronism, which it is, and almost smirk at those who worry about it. Debt destroys empires and ends nations. Yes and no. We'll get into that. It's not a joke. Then this other guy says in response to that, I believe this is by far the most likely driver of regime collapse. And in time of high-stakes political conflict, neither side has an incentive to burn political capital to stop it. I actually agree with that too. So this is where this really gets nuanced. And then in response to that, this guy says that MMT is there to convince, basically, MMT is there to tell all the elites with all the money that it's okay to go in debt because that's the justification that you need to just give yourself more of the nation's money, right?
Yeah.
Now there's a couple things to unpack out of that before we get into this guy's response, which is, if we go back to the original comment about how nobody seems to be really talking about the national debt at the national level, and that the media treat it like an anachronism and kind of poo-poo people who want to bring it up. We've talked about it on the show before. It kind of is an anachronism.
What's an anachronism?
Oh, where it's in the wrong time. Well, like if we make a movie about
That's
medieval
what I thought.
times and we put something in there like a modern gun, that's an anachronism.
That's what I thought. Like, what does this have to do with this discussion?
But I think on one hand, they're right. And then the response that the second guy gives is, in this high stakes political conflict that's happening right now, particularly at the presidential level, nobody wants to burn their own political capital by addressing the debt, which is what they're trying to say is we need to spend less and tax more, right, in order to pay this debt off. Nobody wants to address it because the ordinary person gets burned, or special interest groups get burned by having that happen, which leads us into our MMT comment. So this guy, the sortortionist, apparently has been following us for a while. He says, debt in a currency you can't print is not the same as deficit, which is wrongly called the national debt. He says, I was into Austrian econ and gold for a long time, but these two made a better case and changed my mind. And he posted a very old video that we did on a previous YouTube channel.
Yeah.
And the point being, and we can go over this again here, is that when nation has control over its own currency, what the debt is in that currency is a categorically different thing from you and I being in debt in that currency.
The public debt.
Right. So when he says up here that MMT is to convince the elite class that debt is not actually the problem, we actually have a word concept fallacy. Because what does debt mean?
Yeah. So what debt are you talking about, first of all? Are you talking about government debt or private debt? Now, I know that the Austrians are going to say it doesn't matter. It's all debt. It's all future obligation in a monetary unit. So they're, by definition, the same thing. But they're not. They're ignoring the fact that in one case, the issuer can create the currency that they owe. In the other case, the issuer cannot create said currency.
Right.
That is a category difference, a categorical difference between
totally different. Yes.
And that's important. I mean, whether you believe then that okay, they can issue, but they're not supposed to issue money all the time because that causes inflation, blah blah blah. Yeah, we know all the goalpost shifts that ensue afterwards when you start to point things out to these people. But first of all, we have to acknowledge we're talking about, when you say the word debt, it's meaningless. Well, you have to specify, do you mean public debt? Do you mean private debt? Let's just assume, because I think that's what it is. Obviously, in my opinion, for the sake of this conversation, they're talking about the public debt.
Right.
Would you agree? Yes.
I think so. Because why else bring up MMT? Because MMT, I mean,
Right.
It talks about both, but people think the idiot interpretation of MMT is, oh, these people are saying debt doesn't matter, so we should just print more money. Right? That's what I feel like he's bringing up here.
Right.
This guy gives this answer, which, I mean, he's got a little bit of a word concept fallacy here too. Maybe not a word concept fallacy, but he's mixing up deficit and national debt. They're not the same thing. But he does make a good point. Debt in a currency you can't print is not the same as debt in a currency you can print, right?
Yes.
Now, some other guy, Alfro Mouse, says, if offered to give you $150 in my own counterfeited notes for $100 of government-issued banknotes, would you take the deal? Sounds like a pretty good deal. You get a good return, and the additional currency circulating won't harm anyone, according to MMT. So, this is kind of the word salad rabbit hole, goalpost word salad rabbit hole that these conversations move into. Is one of the assumptions there always seems to be is that the money that the government creates is counterfeit money. And I've never really heard a clear way of why that makes sense. I think it's something to the effect that it's not really money because it's either because it's not gold. Neem, are you frozen?
No.
Okay. It's counterfeit either because it's not gold or backed by something real, or it's counterfeit because it's utilized by monopoly on the initiation of the use of force, and nothing is valuable that is derived from the initiation of the use of force.
Counterfeit because it's created out of nothing. So okay, let's take them. Let's meet them there. The response to his so he's making the point, and somebody clarifies later. So he clarifies later on. So we're gonna steelman his argument here.
Right.
First of all, if I offered you $150 in my own counterfeit notes for $100 of government issued banknotes, if the counterfeit notes that you're offering me, first of all, from an individual level, if the counterfeit notes you're offering me are indistinguishable from real notes, then
how would
why
I even know? Yeah.
Okay, but why would I not take that deal? What's your point? Of course I would take the deal. Right? I surrender $100 and I get $150. What's wrong with it? Why would anyone not take that deal?
Or on the flip side, if I could tell that they're counterfeit, who would take that deal? Right? If they're distinguishable, like
Yes.
if the counterfeit's distinguishable from the real thing, I wouldn't want to touch it.
No, okay, so but
Right?
his point is, I mean, he starts from an individual level, which I don't really understand, because we're not making an individual case, you're making an aggregate case. But okay, if you offer me $150 for $100, yes, I would take that deal. But what his point is, what his thought experiment is alluding to, I think, which is interesting, is would that be good for the economy? In other words, for corporate profits and individual incomes and and production and the goods that individuals can afford in aggregate in the economy? And my answer would be, if the economy is an austerity economy and the private sector, or some individual austerity economy with insufficient net private saving, in other words, and we have unemployment, and the private sector takes on the role to introduce the tax tokens into the system that allow people to save up net private savings and pay their taxes more aptly, etc., and save up money for the future, then yes, that if the private sector takes on that task by counterfeiting perfect money up to the extent where the economy is at full employment, then it would in fact be good for the economy. There's no difference as to whether the government introduces this new money vis-a-vis the private sector.
Or the
Uh,
private sector introduces it. Yeah.
into this sector, so I think it's an important thing to understand about economic, about MMT. We're not promoting particular government programs that come alongside the money that the government introduces. We're just telling you that the economic machine cannot function. You cannot have full employment. You cannot pay your bills on an aggregate scale, individually, everyone in the entire economy, if there's if an insufficient amount of money is injected vis-a-vis the taxes that people have to pay. And this is something that I think it falls on deaf ears with people like them. And I don't know what it is, but it just doesn't really. There's some blind spot, but
Well, I
the
think
fact
I know
that-
what the blind spot is, and we've discussed this before, is that there's a basic set of assumptions. And if you take, and for simplicity's sake, let's say there's the Austrian basic set of assumptions and there's the MMT basic set of assumptions. If you take what we're saying, like what Nima just said right now, and you apply that to the Austrian set of assumptions, what Nima said makes absolutely no sense. However, if you take it with the MMT set of assumptions, it makes perfect sense. The question becomes, which set of assumptions are more accurate? And if we can't have a discussion of starting about, okay, what are the assumptions that we're working with? We split off into these two. I mean, honestly, they're kind of like two different economic languages, and the translation doesn't go through, right? Me and Nima, we understand both the Austrian and we understand the MMT, so we understand the language that they're trying to speak. But we're trying to teach them a new language, and they're not getting it. Like, and it's not just that they're not getting it. I don't think they accept the fact that there is another language to learn, right?
Correct.
And the set of assumptions, I think we've boiled this down, is barter theory of money versus credit theory of money, and the economic equilibrium. Those two things. So the Austrians assume the barter theory of money, and they also assume that there's such a thing as an economic equilibrium in between supply and demand of any given thing. And from there, they start applying. They take those two assumptions, and then they go to, okay, let's start applying philosophy, which is where they get this, okay, there's the initiation of the use of force, and these are the things that happen, and here's what happens when the free market does stuff. So you have government on one hand, which screws things up, and free market on the other hand that does things without the initiation of the use of force, and they build a house on top of the assumptions with those two things. Now,
and they come to economic conclusions.
They come to economic conclusions, and what I've found is that when I start talking MMT to a Austrian or even a neoclassical guy, is they think I'm arguing with their philosophy.
Right.
Which whether or not the initiation use of force is bad, or whether taxation is theft or not.
Yeah, and that's a good
Right?
thing to get out. That's a good thing to get out of the way. We disagree that taxation is theft. Sorry, we agree that taxation is theft. We agree that voluntary choices trump compulsory choices. We agree that the government is evil and gigantic and dangerous, does all kinds of dangerous things, and the more money is at their disposal, the more dangerous they get. So we agree with all these things. We want a small government and a large private sector. We agree,
We
right?
want lots of freedom.
Lots of freedom for the
We want
individual.
everybody to be rich.
We want everyone to have Mercedes and villas, exactly, mansions. So the so we agree on those philosophical ideals. Can we somehow get an acknowledgement on that? No, I guess it never really can, because this person blocked us. So I mean, we must be really horrible people in his view. But we agree on all these things. We want a small, tiny government. We want a large private sector. We want maximum voluntary choice, no compulsory choice, and we are on the same page basically. But what we disagree with is the methodology of how we get there. What we disagree with is the interpretation and the analysis of how the monetary system works. Because in these people's minds, there is a certain stock of gold that we start out with in the private sector, where people have chosen to use gold for their transactions,
Or
and then
silver, doesn't matter. Yeah.
gold or silver. The government comes in and starts taking some of the gold to do their programs, and then they start issuing paper money on top of the gold and make the gold currency irrelevant, introduce a fiat money, and then they start printing money out of nowhere, right? That then
Now there's more money than gold, so it's
as more,
counterfeit in quotes. Yeah.
and they're issuing bonds to raise more money out of nowhere, which then the future generations have to pay off those debts in the form of higher taxes down the road. So it then siphons off resources from the private sector more and more, and gives more and more power to the public sector. That's sort of the Austrian viewpoint, and it all starts, as you said, with the barter theory of money. That first we traded seashells for rocks, and in a long drawn out process, humans realized the best media of exchange are the most durable, most homogeneous, most fungible, blah, all these attributes that gold and silver have. And over time, these media of exchange win out. And then we have this perfectly voluntary free market and money and everything. And then the process that I just described ensues. The
Big
government
government comes along and says, we
comes
need
up,
some of that. Yeah.
right, and messes it all up. If right, if this was the case, then yeah, we would be in agreement. But unfortunately, we observe that the capitalist economy that we're in today, and even the agrarian economies from 5,000 years ago, have never functioned like this. There's never been a process where gold and silver competed against seashells and rocks, and then they became the perfect media of exchange. Blah 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 blah. The monetary system always started out as a fiat system. In fact, the earliest records we have are from the Sumerians, where the Sumerian kings would impose a tax that is payable in a certain token, and then the public would so they would spend that token into existence to hire the public for public works programs. And now there was demand in the private sector for these tokens because they were acceptable in tax payments. Yes, there have been periods where these tokens were issued to commodity values, such as grains in the case of Sumerians, etc. But the government was printing the tokens.
I want to add a note to that here real quick in terms of the grains, because I have had this comeback, which is to say, okay, yeah, but the Sumerians, their money was actually measured in grains. So they had silver and they measured it in grains of rice. So it was actually a commodity of grain, and they used the silver. Well, yes, it may have started out because grains are very, very important, right? But as we're going to see here with the tobacco example, as we go down this Twitter conversation, is you see this interesting relationship where, okay, everybody talks about paying things in grains, but at the end of the day, most payments aren't made in grains. Let's break that down, which is to say, okay, the priesthood, which is the government back in the day, says, okay, you owe 1,000 or 100 bags of grain or whatever, right, for your taxes this year, Nima. And Nima doesn't grow grain. Nima has sheep. He has fruit. Whatever. And so where is Nima supposedly supposed to get this grain? Well, the barter theory says, well, he goes and barters with Dylan because Dylan has the grain. And what actually happens is that the government says, okay, this is what everything's worth. Not because the market decided it, but they said, okay, sheep, that's worth 10 bags. Fruit, 1 bag of fruit is worth 3 bags of grain. A slave, depending on, is a male slave, is a female, they set the prices. Mm-hmm. They said, this is what everything's worth. It had nothing to do with the market. Now, once they set the prices, it's not that you're trading grain. It's just that was the original thing that it was measured in. And so, okay, Nima's got the sheep. He brings it in. That's worth 10 grain. He might get a token that says this is worth 10 bags of grain, and then he can go trade that token. So even though the conversation kind of starts about grain, because that's really the most important thing to feed everybody, in reality, the money becomes that token. Mm-hmm. And I think that's a really, really, really important distinction. Like, there's a flavor of barter in here, but when it comes down to the functioning of the economy, it's the token that's the really important thing.
Yeah, and Carlos Rios just commented, and he said that sounds like communism, and that is kind of somewhat accurate, actually. The oldest monetary economies were kind of communistic, ironically. They weren't, the free trade wasn't there first, is our point.
Right, when the king conquers another thing, they're not like, okay, how do we set this up so everyone has the ability to have freedom and maximize their quality of life? No, they're like, how do I get tribute?
Yeah, the free market was a corollary of the military conquests of the Romans and the armies in general, because supplying and being in charge of supplying an entire army on your own is a pain in the ass. So what did they do? They told the soldiers, you conquer this territory, you get this token as a reward, and we will demand this tokens as a, yeah, so he agrees with that. Libertarians seem to assume that the market was always free. Right. No, I mean, the free market was an outcome of military conquests, right? You have soldiers get rewarded in some token. Let's take the most extreme case, and I invent a token called Nima Bucks, and I tell the soldiers, hey, go to that territory, conquer it, and I'll pay you Nima Bucks. The soldiers will be like, well, what are the Nima Bucks worth? Then I tell them, well, I will tax the territory that you cover. I call it Nima Stan, and everyone owes me 10 Nima Bucks per week. So the soldiers understand now that, okay, there's going to be a demand for this token. We will be able to purchase stuff from within the private sector because all these people need this token to pay this tax that you've now imposed. So now I don't have to be in charge of producing all the stuff that these people need, the soldiers need. Feed the horses, feed the soldiers, shelter, training, etc., etc. They can go on the free private market and obtain those things. So the private market was basically an entourage. The free market was an entourage to the emperor's military conquest campaigns in the past.
Well, and I think it's worth pointing out how deviously clever the system is, right? Because, I mean, there's a bunch of steps in the middle, but if you look at the beginning and you look at the end, this is just a violent transfer of resources from the private sector to the public sector, but the private sector doesn't feel that, right? They just go, how do I make money? Mm-hmm. Right? I need to start a business. I need to get a job so I can make money. I mean, yes, I got to pay this tax, and I don't like the tax. But what ends up happening, like Nima just described, is that the soldiers get services from the conquered people in this example. But, you know, they conquer, and instead of just straight up saying, oh, we're going to confiscate everything, which I'm sure they did. that too. But hey, let's set up the system where you work and there's this market and the market goes back and forth. But like I said, at the very ends, the structures created by the government that has the violent authority to demand the tax, it creates the arbitrary token out of nothing, gives it to the soldiers for their work, and then the soldiers are able to exchange it with the local population, in quotes, the market, so the local population can pay that tax. So the money is completely made up, and the mechanism is resources go from private sector to public sector.
Exactly.
Yeah.
So we have this. We're just going through this in warp speed, I guess. But you can watch our other shows where we go through MMT and the history of money in detail. So this is the basic empirical observation that we're coming from. The money system has always been a fiat money system. And yes, at times, the fiat money to some extent has been stamped on gold, because gold is a great a medium to do that, especially when you don't have digital technology. If you want to have some medium that can't easily be procured by everyone and counterfeited by everyone, you would use something like gold, stamp the emperor's coin on it. And by the way, according to some researchers, the coins, for example, the Roman coins with the emperor's head on it, circulated above the value of just the gold content because they were valued in the settlement of tax debts. So the value that the item as a tax token provided was far larger. It's just the pure gold commodity value. So that's
Right.
one
Well,
thing
and
to
then
notice when people talk about ancient systems where people used to use gold, and that's why it used to be a commodity money system. Well, not necessarily. It used to be a fiat money system where the liabilities happened to be stamped on the medium known as gold or silver.
Well, two things I want to point out. If the gold were ever to be worth more than the legal stamp, then it's more valuable to just melt the coin down, right? Even if it's illegal, I'm sure people would hide it and make that happen. But I think what's really important to add on to that, Nima pointed out that gold and silver are a very good medium to make this happen. There is one really bad aspect about gold and silver, which is that it can be stolen.
Yes.
And when you talk about this on an international level, that, okay, the Spaniards just came from the New World bringing all this gold, and we're British. It's like, man, we don't even need to mine the gold. We can just go steal it from them.
Yeah.
Right? And because we could just melt it down into our coins versus their coins, there's a very large value in stealing other people's gold. And in the early Roman Republic, this is not well known, and I learned this from reading a book called The Lost Science of Money, which unfortunately the guy just makes an absolute mess of his early chapters trying to explain this. I had to read those early chapters like 3 times to understand the point that he was making. But the early Roman Republic had bronze money. It had bronze money. And the apparently numismatists, these are like historians of money, look at this and say, they can't figure out, like, why are they using this money that has really no intrinsic value to it, because bronze isn't worth that much. And the point that the book is making is because, as they say, it's the legal value that's important. And they purposely stamp it on something like bronze so you don't worry about it getting stolen. Right? You don't worry about like a conquering community coming, give us all your money, because it's a legal thing. And what's even more fascinating is when Rome finally switched to silver, was around the time it was one of the Punic Wars. I want to say it was a second. Don't quote me on that. This is like 250 BC sort of era, where Rome is really starting to conquer more and more of the Italian peninsula, and they're bumping into other communities that are using silver and gold coinage. And what's interesting is that so Rome now switches over to silver. However, the money that they paid to the soldiers out in the field in these other communities, or other tribes or whatever they were at that point, versus the money they printed at home, the money they printed at home had a number on it, like 1. This is worth 1, I forgot the name, denarii or whatever the coin was at that time. But the ones paid to the soldiers abroad had no mark. And the conclusion drawn from that is that at home, this money has a legal value. But abroad, it doesn't because you're in somebody else's jurisdiction. So what's important is the weight of the silver and what that weight trades as a commodity. Because we don't have control over I mean, not yet. We don't have control over the legal value of the money in that other country. So this whole thing about Rome finally fell when it started debasing its currency and quit putting gold and silver in its money. Well, that I mean, I'm not saying they didn't do that. We could extract a little bit more from that if we have time, but that completely ignores the fact that Rome was very successful at the beginning utilizing bronze money.
Yeah,
And that
correlation.
even when they did the switch, there was a difference between home money and money abroad.
Correlation doesn't equal causation.
Right.
So yeah, we have had gold money throughout history, but don't confuse that with the idea that gold in and of itself was independent money. Now, there have been periods, as Dylan just pointed out, in particular the Axial Age and the Colonial Conquest Age. So these are the periods from around 800 BC to 700 AD, and the periods of 1400 through 1971 AD, where gold was to some extent used just as a currency based on its metal value. But these are periods, generally speaking, these are usually periods of universal warfare and lack of trust or breakdown of trust among parties, among groups, among individuals. And in those cases, of course, the features of gold are very important, namely the fact that it can be stolen easily without any track record of who it belonged to previously. You can't do that with debt obligations and currency issued. I mean, it's harder to do it with currency issued by other people, but with gold, you can just melt it down, and nobody will be able to track its origin or where you got it from and whatnot. So in times of complete breakdown of trust, yes, gold in and of itself, pirates burying their treasure and all that, that has happened. But it has happened in situations of complete breakdown of trust and or among groups who just, whose business is stealing money, which is cumbersome and annoying and much less difficult than just creating your own money and moving resources in your direction when you have the legitimacy of the state apparatus behind you. So this is just a drawn out way to say that this is our basic understanding. And talking about the colonial money, because people always say, like this guy said, the US started with a gold currency. So there is a line here in Wikipedia that discusses the history of colonial currency. And one paragraph in particular basically says it. The paper bills issued by the colonies were known as bills of credit. Bills of credit could not be exchanged for a fixed amount of gold or silver coins, but were redeemable at a time specified in the future. Bills of credit were usually issued by colonial governments to pay debts. The governments would then retire the currency by accepting the bills for payment of taxes.
There it is. Exactly what we just described.
Yeah. So again and again, you look back in history, you look back in American history or world history, we always find that this fiat money system is not so novel and not so sinister as people make it out to be. It's more like it has been the constant feature of our economies. In particular, the more industrialized economies become, the more the bigger the importance of money. If you are in an economy with mostly self-sufficient units who grow everything for themselves, right, then money is not that relevant, not as important. But the more the specialization of labor requires you to obtain things from somebody else, and they have the same requirements in terms of resources, etc., then the importance of money rises, obviously. That's where we're coming from when we say that MMT can give us some value of some valuable prescriptions in fixing present day economic problems.
Before you jump to that, Nima, I want to wrap up what we mentioned at the beginning, which was this idea of we're not attacking the philosophy of the Austrian econ or even the philosophy of the neoclassical econ, is we're looking at what are the fundamental principles. And we said, okay, we disagree on these two fundamental principles. And we'll, for the sake of this conversation, we'll just say the one: barter theory versus credit theory or state credit theory of money, right? And we could say, okay, if you go down barter theory road, you end up with an Austrian or a neoclassical view, or if you go down state credit theory, you end up with something more like an MMT view. And the question then becomes, and I think this is the most important one, which we've just been discussing example after example, is what does the evidence support?
Yeah.
What does the historical and economic evidence support? And on team Austrian, on team neoclassical, on team barter, they're just like completely uninterested in looking at evidence and looking at historical or archaeological or anthropological or economic evidence, anything, right? And we're pointing out that the evidence supports the state theory of money, and we need to start there. Once we start there, we can say, okay, let's apply a philosophy, right? Let's apply, ethics or whatever, but we have to start at what is reality first. Like, what's the reality that we're working with that we're applying this philosophy and ethics to? And we're making the argument that the evidence supports the credit theory of money, not the barter theory of money.
Well, certainly
Yes.
that it's a historical fact that that the credit money has been a thing for as long as human civilization has existed. That's hard to deny, and and, and so that's where we're coming from. We have another comment from Carlos. Hey guys, so I've heard
Interesting.
the story about the creature from Jekyll Island, and I think fiat money gets a bad rap because of it. Was it really a maniacal thing that took place there? Yeah, that's the creature from Jekyll Island by G.W. Griffin, I think. Right?
G. Edward Griffin. I'll say this on the creature from Jekyll Island, and I've listened to lectures by G. Edward Griffin, and I made it about halfway through the book. I'll be honest, I didn't finish it. I made it about halfway through the book. Is that we're not saying that there aren't evil bankers. We're not saying that there isn't a secret Illuminati cabal that's trying to take over the world and exterminate everybody, and one of the ways that they do that is through economics. We're not saying that at all. What we're saying is because the people who tend to think that are working with the wrong rules. They're working with the wrong map of how things work. They come up with wildly false solutions. They come out with totally erratic solutions, and unfortunately, the creature from Jekyll Island is one of those things where I remember specifically from the book when he tries to explain equilibrium, which is to say, okay, Griffin gave this specific example in the book. I remember this. Is he said, okay, let's say you have a community. It doesn't actually matter how much gold is in the community, because if you have 1 ounce of gold within a community of 10,000 people, if you're able to put a little bit of ounce of gold and a speck of gold in each coin, the prices are going to reach an equilibrium where everything's going to work out, even if you have a small amount of gold versus a big amount of gold. Now, I've got 2 problems with that, at least. The first problem is I don't believe in this equilibrium nonsense. And the second problem is, so you're saying if the community next door walks over with another gold coin, you just inflated everything by 100%. Right? You're just completely subject to the whims of some other community that can either take the gold out or put more gold in to completely disrupt what's going on. In terms of the Federal Reserve itself, I think that there's a lot of people and the upper elites that really benefit from how the Federal Reserve works, but not the way you think they do. And the Federal Reserve has a lot of control over the economy and the banking sector, but not in the way that you think they do. I mean, we've gone over this in other shows where what was it? It was the Silicon Valley Bank, and was it like First Republic Bank or something like that? We looked at the balance sheets of what was leading up to these banks getting closed down, and what exactly the rules that they were breaking was, were the rules that they were breaking were, and it had nothing to do with this fractional reserve system. And it had everything to do with here's what the law says that the bank needs to do. Because the entire thing is a legal process, not a physical commodity process. So, with the creature from Jekyll Island, yes, there are evil people colluding to do bad things and to steal from us.
Yes.
In
So
terms of the way that the economy and the Federal Reserve and the banking system works, Griffin got it all wrong.
yeah. So there's a lot of people. There's a whole community around Creature from Jekyll Island, and even before that, the Austrian economist Rothbard. Mises, not even that much actually necessarily, but a lot of people have this. The Ron Paul movement have this laser focus on the Federal Reserve Bank and the fact that they lend money into existence out of nowhere, supposedly, and that they monetize the debt and all these things. We can clarify what these things actually are. They're not really what they think they are, in our opinion. But the Federal Reserve Bank. So before the Federal Reserve Bank existed, there were other banks in the U.S. that took on the role of the Federal Reserve. There was a first bank of the U.S. There was a second bank of the U.S. There was all the way back
I
to
think
the
the Fed
original.
is the fourth, isn't it? I can't remember if it's the third or the fourth.
Yeah, well, I'm just talking about there was a bank that was literally called the first bank of the U.S.
Oh,
and there
I
was
see. Yeah.
one called the second bank, and there was Alexander Hamilton. All these people were involved in those decisions in the early days. But the challenge was always that, okay, people have this currency that they transact with. How do we ensure at par clearing across states in this vast territory of the United States? And one of the rather neutral tasks of the Federal Reserve is to just be a clearinghouse for all the different banks across the entire country, because it's
What
not easy.
basically making sure that a dollar equals a dollar no matter what bank that you're banking at, right?
Right, right.
Yeah.
Which philosophically and conceptually does make sense, right? If I earn money, if I've provided a value to someone that's worth $50, then that $50 should be $50 in the territory that claims to use the dollars as a system. And individuals can still, individual territories, they can still adjust their prices according to standard of living, cost of living, etc. in the area. But when I transfer $50 from a bank in Florida to a bank in California, I want the number that I want to show up in the new bank is $50, right?
Right.
So that's something that the Federal Reserve makes possible, is at par clearing. And the Federal Reserve Bank, by the way, is not one bank. There is one
13 of them,
federal.
something like that.
There's 13 different reserve banks across the country, and the local banks are members of those reserve banks. And one of the things they do is obviously at par clearing. Now, the one thing that the Federal Reserve does do that we heavily criticize all the time on this show is the attempt to manage the risk-free interest rate, because they have their quarterly meetings or whatever, and then the chairman always steps on the podium and gives a speech, and the markets are laser focused on what he's saying. Oh my God, could the rates go up sooner than we thought before? This is complete nonsense, honestly. This whole focus on the risk-free interest rate as if it is some high impact economic variable that changes the alignment of factors of production, and that can increase or reduce inflation and or production, etc., etc. That is not really the case, and we've talked about this many times. When the Federal Reserve, the common wisdom is that when the Federal Reserve cuts the rates, then they are permitting more inflation. When they raise rates, they
Because people are going to borrow more money from the banking system because it's easier to
exactly
borrow.
to
Yeah.
borrow more money because rates are lower, etc., etc. So that will increase inflation, and if they raise rates, then that will reduce inflation. But empirically, there's no evidence for this supposed correlation. People have tried to draw this conclusion over and over, tried to make the case for a correlation that does not exist. And Professor Werner, the economist, has also done this research, and he concluded, well, it actually looks more like the Federal Reserve happens to follow whatever the current rate of inflation is with their interest rate policy. If inflation goes higher, then the Fed starts raising the rates. And inflation starts going down, then the Fed start dropping the rates. We see this over and over and over. It's so boringly predictable at this point.
And then watching the rest of the economy freak out, be like, "Oh my God, they're doing this with the rates, and they're doing that with the rates, and
Right.
Peter Schiff just screaming it. They're raising the rates, it's gonna end. They're lowering the rates, it's gonna end. And it's just not that big of a deal.
Right. And when Trump was president, Trump was super proactive, stepped out and said, Powell, you need to cut the rates. And then Powell cut the rates. And then Trump came and said, you have to cut them more. It's not enough. And so Powell's like, okay, I'll cut them more. And now that Powell is cutting rates and Trump is not in office, Trump is upset about that. He's like, oh, he's just doing it to help Kamala. And he did it too soon. The inflation is still a risk, blah, blah, blah. So
it's all a distraction.
This topic is so loose and so foggy. Nobody really knows what they're talking about when it comes to inflation, interest rates. But the Federal Reserve proclaims in the current economic orthodoxy, claims to be able to manage interest rates by adjusting this one dial of the interest rate. And by the way,
claims to be sorry, you spoke wrong. They claim to be in control of the inflation by adjusting the dial of the interest rate. That's what I meant to say. Yeah.
Correct. And by the way, in fact, if you look at it mathematically, raising the interest rate actually increases the amount of money that's injected in the economy. The net new money that is injected into the economy is higher when interest rates are higher and lower when interest rates are lower. Because when a bank makes a loan, yes, it charges an interest rate, but the loan creates a deposit, and the deposit pays an interest rate, unless you keep it in checking, but that's a small amount. Most people move their stuff into interest-bearing money market or savings accounts. So that's a wash, basically. Whatever the rate increase by the Fed, so let's say the Fed increases the rates by 2%, the loan rate will go up by around 2%, and the savings interest will go up by around 2%. It happens every time, reliably.
And treasury bonds obviously go up by 2%. Yeah.
Yes. It depends on the duration of the treasury bond. If it's a short term, then it just follows. If it's a long term, it's more linked to the expectation of future rate policy, right? Because if it's a 10-year bond, it is influenced by the investors' expectations of all the individual rate hikes in this 10-year period. Correct. So it's an estimation, speculation. So this is why these longer rates are more volatile. They constantly change when the Fed speaks and announces a certain policy. This whole schedule that the market expected can totally change. That's why these rates, the longer term rates, can change a lot. The shorter term rates are more reliable because we know what we know sort of what the Fed is going to do in a month, or actually less than a month now. November.
Probably going to drop a quarter or half point.
That is, yeah. Currently, the betting market is 88% for a quarter drop. So yeah, longer term we don't know, right? It's called the dot plot chart, and we can get into that in more detail. But if you look up dot plot chart, you can see what the betting market is kind of where people are putting their money as to where they're expecting the rates to be. So this is something, just to end this Fed discussion, but this is something where we criticize the Fed, creating this whole uncertainty of raising and cutting interest rates all the time, when what they could just do is declare one rate for eternity and never change it.
Be done with it. Yep.
It would increase it would increase stability immensely and predictability of the financial sector incredibly. Because one thing that rate changes do is that they have a huge impact on asset prices. That's not inflation. That's not consumer prices. That's not producer prices. But that's the price
Price
of
of credit
future
that it
claims.
costs to buy that thing. Yeah.
The price of future claims to money, and yeah, with that, the price of credit as well. But basically, the price of stocks, the price of bonds, uh, the price of gold actually as well in a roundabout way, which I'll get to in a sec. But when the risk-free rate drops to zero, for example, the proposition to invest in a risky stock is much more feasible than when the risk-free rate is 10%. You know,
Right.
we're
Yeah.
picking these
Why
extremes.
would I invest in a risky 5% stock when I get a no risk 10%
Exactly.
bond? Yeah.
Unless the stock price adjusts accordingly and it now makes it worth it, right? Now the expected profit per share is 30%, right? Now it makes sense, but the stock price has to come down to justify that. If the stock price, the stock price is, if the long term profit per stock is like 10%, and the long-term rate is 10%, well, then I'll just put it in the long-term risk-free rate is 10%. Then I'll just put it in the long-term risk-free investment asset.
Right.
And
So that's a really good point you made, because whether they kept it at 2% or 0% or 5%, whatever they pick, just the fact that it's going to stay there and be stable, we could everything could everybody could just chill out.
yeah, they could,
and just know what the interest is.
they could set the rate
Yeah.
to zero. They could set it to 3%, to 2%, whatever it is, 0.25%, and leave it there for eternity. They could set it to zero. They could set it to negative, but that would not be a good idea, because that is institutionalized austerity, basically. Because Carlos also mentioned negative rates. I appreciate the response. I heard at one point that the Fed wanted to issue negative rates, whatever that means. Yeah, actually, they did in some countries. In Japan, they went negative, and I believe the European Central Bank also went negative at
That
some
means they
point.
take money out of your account.
Right. So this
Yeah.
means that in the aggregate, the money, the individual savings is depleted over time. So now we have a tax base. The Federal Reserve is taxing the private sector on top of whatever the government is taxing, withdrawing money from the private sector and ushering in a, most likely, depending on fiscal policy, but definitely introducing another lever of austerity for the long term in the economy. So that's really all that negative rates do. But if you're a monetarist, if you believe that rates have an impact on money growth and credit growth, then their belief was they make the rates negative so that the money supply grows and that more people borrow money and all that stuff. But that didn't happen.
Yeah. All
The
you're doing is
opposite
you're
happened.
sucking money out of the system. Yeah.
You're sucking money out of the system. And so now here's the reason. Why don't people borrow more money when rates go negative? Because their incomes decline when rates go negative. When rates go down, the private sector's income goes down. When somebody makes a loan, guess what they look at to decide whether or not you're creditworthy? They look at your income. If you don't qualify with your income, you're not getting the loan. So the current interest rate is much, much less important than the borrower's ability to pay, the borrower's ability to take on the loan. And that is hampered by negative interest rates, because in aggregate, it sucks money out of the private sector.
There's two other things I want to unpack, actually, from The Creature from Jekyll Island, because there's so much in there that is, I think, has really screwed up this conversation. The first one is the private versus public nature of the Federal Reserve, and the second one is fractional reserve banking and the implications thereof. So The Creature from Jekyll Island basically puts forth this idea. These secret bankers met on Jekyll Island, created this Federal Reserve, and they said, we're going to own it, but nobody's going to know who we are. And so we're going to create the money for the country, charge interest for that money creation, and that interest paid is going to go to us so we could suck up through this mechanism the productive power of the country. Now, I'm not saying there isn't a group of people sucking up the productive power of the country, but they're definitely not doing it in this way. If you just bother to read the Federal Reserve Act, this is what blew my mind. Right? It's like I assumed that maybe G. Edward Griffin did a little bit of reading of the Federal Reserve Act. The Federal Reserve Act is very, very clear who the in quotes, I can't remember if it says members or stockholders or shareholders, one of those, whatever term it's using, that's using kind of this private corporate language. They have no control over the Federal Reserve. They get a very, very minimal amount of money, and who they are is completely public. They are 100% completely public. There's no like who are the members of the Federal Reserve or who are the shareholders of the Federal Reserve.
Well, yeah,
no, it's completely public.
and there's people who think that the Queen of England is somehow, or King
Right.
of England is somehow the secret owner of the Federal Reserve. Whether or not that's the case, what does it matter? Where does so if that's a problem in your mind, where do you fix it? Where do you see the king meddling, and then you can go there and say, "Haha, I got you, king." But that's not really the case, right?
It's not the case at all. The reality is, and I made a complete video going over the important points of the Federal Reserve Act and breaking this down to show that the private banking influence over the Federal Reserve System, because the Federal Reserve System starts at the top. There's the Federal Reserve Board of Governors. They're the ones that they have to work within the framework of the Federal Reserve Act, but they make the policy for all the individual 13 Federal Reserve banks. Now, each of the individual Federal Reserve banks have their own boards, and they can make policy for their own individual banks as long as it's in line with the Federal Reserve Act and what the top board says. Now, in terms of where the private banks have influence, first of all, at the top board, it's 0. There's like 5, 7, 9 members. I can't remember off the top of my head. The president appoints, and I think it's just the Senate. I want to say it's just the Senate. The Senate confirms all 7 members, and then the chairman and the vice chairman are selected from there. So there's nothing private at all whatsoever to do with that top level. At the individual 13 levels, there are 3 types of people who sit on the board. There's a Class A, a Class B, and a Class C. Class A is chosen by the top board of governors, so that's 100% government. Classes B and C, I might have B and C backwards, but I believe B is the member banks of that individual regional Federal Reserve Bank. They elect board members from the banking institutions to sit on that board. There's your first private. And then the third is C, which is, I can't remember who chooses them, but they're people from the community that specifically have nothing to do with, they can't be an officer, they can't be an owner, they can't be a president, they can't have anything to do with the banking system. They need to represent agriculture or labor or industry or something like that. They sit on these lower boards, and when it comes to the decision-making process that these lower boards are able to do, half the time, the Class B, which is the ones selected by the banking system, they don't get to vote. I mean, like the level of cascading down that you have to go before any influence whatsoever is exerted by the actual banking system is minuscule. And to the point that you were making, like, okay, let's say that the King of England is one of these members. What does that mean? In terms of what these members are paid, yes, the Federal Reserve is set up like the Federal Reserve System is set up like a corporation. They got profits and P&Ls and profit and loss sheets and balance sheets and all this sort of stuff. And they talk everything about, here's our interest, here's our profit, here's our losses, that sort of stuff. But when they get all their, in quotes, profits, 2% of those profits get sent out to the member banks. And Nemo, where does another 98% of those profits go?
To the Treasury.
To the U.S. Treasury. Okay, so this whole thing about there's this secret cabal of bankers and we don't know who they are and they're sucking up all the profits over having monopoly over the money creation. It's just so blatantly, stupidly false. You can figure it out by reading the Federal Reserve Act. And the goalpost response that I get to that now, Nima? I don't know if you've seen this. Oh, you think the Federal Reserve Act is the way that they're actually doing things? You just believe what the government tells you on a government website? Like, obviously, people who have never, ever interacted with a bureaucrat before. Bureaucrats are obsessed with the rules.
Yeah. I mean, there's on this question of whether or not the Fed is public or private, I kind of hate it so much because it's such an esoteric and theoretical conversation. But yeah, back in the day when I still had my blog, I wrote down, and by the way, I noticed the other day my blog has been taken over by, or my old domain has been taken over by some other, I don't know, demon website or something, so,
Yeah.
like a Diablo website, whatever. I don't know, but because I just didn't really care about the domain anymore. Anyway,
Oh yeah. Cool dragon. China
uh,
cheap fly in Jersey store.com.
but maybe I should write this up or look it up in the archive. Maybe it's somewhere in the archive still. It probably is in the archive.
Yeah.
Because all these points of whether Fed. Okay, so there's like 10 points I made of aspects or characteristics of the Fed, and you tell me if you can show me a private company where this is the case, then I will hear your argument that the Fed is private. But these things are okay. The board is elected by Congress. Can you show me another private corporation where the board is elected by Congress? The chairman is appointed by the president. Can you show me another private corporation where the chairman is elected by the Congress? The currency is, by the way, issued by the Treasury, the hard currency, and the Fed buys it from the Treasury. So can you show me a business where all the hard products it buys and sells come from the federal government and the government alone? No, of course. The Federal Reserve's profit, 99% of the Fed's profits go to the Treasury. Can you show me another private corporation that takes zero profits, sends all the profits to the federal government? And there's several other points.
It's not all. It's 98%, Nima.
It's so blatantly obvious, in my opinion, that this is a government institution. It should be treated as such. If you want to solve problems with it, then you have to treat it as such and approach it from that public sector angle.
And then let's deconstruct fractional reserve banking real quick too, because this is another thing that's proliferated by the creature from Jekyll Island, and this is, I think, also where a large misunderstanding of the interest rate comes in, which is to say, okay, the way banks work is they open up a bank, and then once they get a certain amount of deposits, they're able to loan out a multiple number of that deposit. Let's say, so they got $100 deposited, they can loan out 10 times that amount of money, as long as they keep that deposit there. So that means they can loan out $900 because they got to keep 10% on the books. And so that allows $900 of money creation. However, the problem is when they've lent that out, so they've lent out $900, and let's say the person owes back $1,000 because it's $900 principal and $100 interest, whatever that interest rate works out to be over the term of the loan, right? Now, in the aggregate system that we're theoretically creating here, there's actually more money owed to the bank than there is money in existence, right? Because $900 has been created, but $1,000 is owed back. And so the way that the economy deals with this is that somebody else gets a loan and says, okay, I loan, I borrowed $900, I owe $1,000 back, and I paid the first guy, he could pay off his first loan, but now the second guy has this running interest debt that can't be paid off by the entire economy because of this fractional reserve system, where there's this limit on how much money that can be created based on the reserve rate or the reserve requirement, right? Nima was one, most of the stuff, who pointed out to me that's absolutely backwards of what actually happens. Is that if there is a reserve requirement at all, and some countries have no reserve requirement, like Canada, for example. If there is no reserve even if there is a reserve requirement at all, what creates the money has nothing to do with the deposits that are sitting in the bank. What creates the money is the bank going check and creating the money. And what speeds them up or slows them down are the number of ready, or how do you put it, willing and able borrowers.
Yep.
Right? So Nima's the bank. I got a business idea. I come to Nima and I say, look, here's my business idea that's going to create this much cash flow. I need $100,000. And Nima does his underwriting and go, well, this is a pretty good risk. He should be able to pay this back. Or they go, no, this is too risky. We're not going to do it. If they say too risky, the money doesn't get created. If they say, we think you're good with that. Now the money gets created. Nima gets the $100,000 to go run his business with. Then after that, they go, okay, what's the damn reserve requirement? Okay, at the end of the week, make sure that we get that much reserves in the bank.
Right.
And what's important on top of that is that the reserves are literally always available. Either on the interbank lending market, because the banks lend each other these reserves all the time, or in the last resort, the lender of last resort, the Federal Reserve, every bank has a line of credit at the Federal Reserve where they can get the reserves if they need to.
Yeah, it's actually just works as an overdraft.
Right.
So
So
you don't do anything. The system still functions. You just incur an overdraft at a certain interest rate, which is higher than what you could get from savers or interbank lending.
right. So there's this idea that this fractional reserve lending system has inbuilt into it an eventual crash. Because as this money is getting created, more interest owed is being created than principal in existence. So at some point, the hot potato just keeps getting tossed until somebody holds it, and then the private sector can't finance its own debt it's created, and then everything implodes, and it's limited by, okay, how many deposits are there in the first place?
Mm-hmm.
That's just entirely not even remotely the case, not even close. So, and I think the creature from Jekyll Island is largely responsible for promoting this fractional reserve idea that just isn't accurate at all.
Right. It's as with so many things, it's backwards. We The banks create the money, so the banks don't wait. Just if you think about it logically, the banks and government create the money. So the banks and government don't need your money to be able to make a loan. They make a loan if they find a willing and able borrower and he's worth the risk. They will make the loan out of nowhere, out of nothing, and they will mark up the checking account. And if that person, once that person uses the money, makes payments, obviously now he writes a check to another bank, then that other bank is going to demand the reserves from the initial bank, and now the initial bank needs to attract reserves. They can do that by borrowing from the Fed or from the interbank, or by attracting
Depositors. Yeah.
savings deposits and usually the savings deposits are a lower interest rates than what they can get from the interbank market or from the treasury. And checking accounts, by the way, are the best kind of money to attract because they don't pay any interest on that. Now, just one minor clarification: you said the reserves are always available. There can be situations where the banks get in trouble, as we've learned, as a result of this constant adjusting of this interest rate
Right.
dial.
Well, okay. I'm sorry about that. As a result of somebody playing with the dials at the Federal
Right.
Reserve, not knowing what they're doing.
Right. So,
Yes.
so, so in 2022, the Fed embarked on a really aggressive interest rate hiking spree, which was so unprecedented. It was rapid. It was I don't want to say unprecedented, but unexpected. Certainly, it came out of nowhere, and the whole system. This is part of the problem. The system adjusts around a given rate, just as the system adjusts around what a meter is, or what a yard is, or what a cup is, or what a foot is, right? Imagine the Fed came out and was in charge of these
Yeah.
numbers and
A meter
constantly
is now
adjusting
this
them.
long instead of this long.
Like
Yeah.
it's like
Right.
all the civil engineers like, oh shit, now we have to
Yeah.
change our blueprints there. So that's kind of like what they're doing with the financial sector by constantly adjusting the rate. But yeah, they could just keep it at one level. But in the case of Silicon Valley Bank, there was indeed this phenomenon where the banks have leeway in their reserve account, right? The money where that comes in from deposits, they can keep it in reserves at their local Federal Reserve bank, or they can a regional Federal Reserve bank, or they can buy treasury securities with treasury bonds, treasury bills. And what they started doing, because interest rates were so low post COVID, right? Because they cut them all to zero. They were higher, then they
Mhm.
cut them to zero. Okay, rates are so low. We want to generate some more income on our reserves. So we buy some treasury bonds that were at the time paying maybe 1%, maybe 1.5%. And they were relying on that sort of configuration for their loan to assets to liabilities
Right.
portfolio.
And then really important, just as a to insert there, their assets to liabilities requirements are entirely arbitrary legal requirements. It's not because this is how reality works. It's just because these are the rules that the government said that they have to follow, and they're
No,
totally arbitrary. Wanted to throw that in there.
no, no,
Yeah.
no, no, that's not what I was talking about, though. So
Oh, okay. Sorry.
the asset liability requirements that I was talking about are not arbitrary at all. They determine whether or not the bank is profitable, because
Oh, I
the
see. Yeah.
the interest paid on their assets minus the interest they have to pay on their liabilities is the bank's profit. So this was not an arbitrary situation. This was the bank's profitability depended on an asset to liabilities match that provided this level of revenue and this level of cost, and so some profitability. But what happened as a result of this rapid interest rate hike was that the value of the treasury bonds in the reserve account started plummeting. In parallel, simultaneously to that, there was some psyop that was initiated by people like Peter Thiel and other VCs. I don't know if it was a deliberate psyop or one born out of economic ignorance, but people started saying, "Oh, this bank looks shaky." But I don't know why. The bank didn't have bad loans on its portfolio. The bank didn't have a bad quarter or whatever, but or maybe I don't know. Maybe they had they missed expectations to some extent, but the bank did have the problem at this point where now all the big money from all the companies, the VCs, which a lot of startups were using this bank for their daily banking. Now all these depositors start pulling out their money, so a lot of checking account money started leaving the bank,
They're
going
cheap
to
reserves.
right the
Right.
cheapest possible reserves. Now, in order to be able to meet clearing demands, right, people writing checks to other banks, and maybe also the reserve requirement, they had to sell some of these treasury bonds and sell them at not insignificant losses. So these losses would then show up on their balance sheet, and the question, and then at the same time, the reserves that they were able to obtain that were non-checking account reserves but savings deposits were so costly because the rates at this time were yanked up to 5.5% or so, and the loans on the interest on the loans that these banks had made in the 2020s, 2021s, etc. Some of these mortgage loans were paying something like 2.5, 2.8, 3% maybe. So there was really no viable model for this bank to continue with these expensive funding sources. And this was mostly just because all this checking money was sucked out because of the panic.
At the
And
same time that the rates got drawn up right after they
right,
had invested all this money in low rate treasury bonds. Right.
exactly, the losses that had to be booked then when the treasury securities were sold. So then they got subsumed by larger entities, and a lot of these deposits went over to J.P. Morgan. I think, actually, in the case of First Republic, I believe they got taken over by J.P. Morgan and
There were
Silicon Valley.
sharks coming after those really good loans that they
Right,
had.
right, because the loan
There was
portfolio was
anecdotal, but there was a bank. Actually, I won't say it. There was a bank that was trying to get my business deposits, and they were whining and dining me, and we got on this. This was right after the Silicon Valley bank fiasco happened, and he said, "Oh yeah, we ended up with a lot of those assets from the Silicon Valley Bank." And I mean, I'm not criticizing him, but what his bank was like, "Oh yeah, we got a ton of good assets from the Silicon Valley Bank." The point I'm trying to make is, it's not like they had bad assets, right? And
yeah.
then when we did that show, I also remember that you were able to show that Silicon Valley Bank was actually making a really good effort to get its books
Yeah.
right. And it looked like he was on the verge of getting there when the, whatever Department of Finance director, somebody or other from the state of California, just unilaterally declared this bank is insolvent. It's done.
Right. Even
Yeah.
though it didn't seem like there was a failure to pay, there was no creditor came and said, "I didn't get my money," as far as I
Yeah.
know. Now, it could be that maybe due to this whole fiasco that the Fed had created before with the volatile interest policy, that maybe there was that created the problem for the bank
Right.
potentially. I don't know, but then guess what? After these two banks were taken over by the big guys, by J.P. Morgans of the world, the Fed introduced a policy where, oh, all these treasury bonds that you have that have lower value now, you can actually just tender them in with us, and we will give you the equivalent amount of reserves in as face value, at face value of the treasury bonds. So problem solved, right?
It would have saved them, but
Right.
they did it
They
five
could have
minutes
done
after they
that
got closed
before.
down. Yeah.
And so, yeah, this whole thing, it's unfortunately too much ignorance about this whole topic to where such a simple solution could have just. I guess it's just too many people yelling and screaming off the top of their lungs that you can't just push a button to solve this problem. But this solved the problem. There was no other banks, really, no other major high-profile bankruptcies or insolvencies of any such banks since then. So that was yeah, going back to the Fed topic, but yeah, that is something we criticize about the Fed, the fact that they try to manage the interest rate, the risk-free interest rate, which is unnecessary, right? And number two, the fact that they did it, for example, in this case, they did it so in such a volatile fashion and in such brutal fashion that just it was designed to catch everyone off guard. They thought that they were doing something smart. They thought that, oh, this all this inflation, that's we're gonna nip it in the bud and stop it by doing something so radical. It's like you have a headache, and so you give
Chop your head
someone,
off. Yeah.
yeah, chop your head off to cure the headache kind of solution. Very crude, very dumb, very ineffective, and like I said, we told people inflation is not going to go down from hiking interest rates. In fact, inflation it kept on going up, but it's going to level out as oil prices level out, because that was the biggest driver of the 2022 inflation. Obviously, was the war in Ukraine, the oil price shock, and obviously then other factors were the
Well,
stupid
there was the COVID shock,
the
right?
COVID.
That we're
Yeah,
still supposedly halfway in, and a big one is the labor shock that we're having because there's more boomers exiting the labor force than there are Zoomers coming into it.
yeah. Yeah, but so there's the multiple effects, right? There was this, okay,
Yeah.
you got to stop working, you got to shelter in place, you got to stop consuming all these things that you used to consume, can't go to the gym anymore, blah, blah, blah. And so a certain degree of the country's productive capacity was just shut down voluntarily. People just decided, okay, let's shut ourselves down to cure the killer coof that's going around, obviously, right? Because that's how you cure a medical issue. You shut down your economy, and then so you reduce supply at the same time. You just loaded up the money bazooka, unlike anything we've ever seen on the global scale. There was never so much deficit spending at one time, I believe, as there was during 2020. Now, maybe in the US, we had World War II. The figures were kind of proportionate to back then. But I don't think on the global scale, there was ever such a coordinated, concerted injection of deficit money into the economy, while at the same time shutting down your productive economy. Okay, so you're reducing your supply, you're increasing your demand, and you prices will go up, and then on top of that you muck up the supply chain, more reduction of supply,
And
then
throw a bunch of money into it on top of it. Yes.
right, and then you launch all these sanctions because you disagree with some country that's far away, that's dealing with a border issue that's none of your business. And so all these things, and it's actually quite amazing how low inflation has been throughout all of this. It could have been much worse. But the US economy is very diverse, very resilient, very large, so it can absorb these shocks over and over. But these were sort of the reasons why we saw this inflation. And whenever the root cause of the inflation began to level out, you would expect inflation to also level out, of course. So that has happened, and now the inflation is coming down. And now, as they usually do, they start reducing the rates as they see that inflation is coming down.
They're reactive, not
Yeah,
proactive.
they're reacting, not being proactive about any of this.
Let's load this this Twitter thing back up. Oh yeah, here's the guy who moves that initial goalpost. So printing instead of taxing just leads to instability. Future prices become less predictable, and you destroy the structure of production. So this is the assumption that, okay, if you're just printing this money as opposed to taxing it and spending it, you're basically inflating the economy, right? And the Satortionist here brings up the point that we're bringing up is money spent into existence first, or is it already existing but in the private sector and then taxed and then spent first? The MMT argument obviously is the first side. The anti-MMT guy says I don't even know if this makes sense. He says historically money started taxed.
Yep. Yeah, this is the barter theory of money in action.
Okay.
In his brain.
So the guy writes back, so dollar bills existed in people's hands first. He's making the very clear argument that we made is where did the dollars come from to get taxed in the first place?
To pay the taxes, yeah.
Right. And then, dollars represented gold. And then there was a back and forth of, how much gold there was versus the reserve. And then Nima finally pops in. It's my face, but it was Nima writing that, like we mentioned at the beginning, the first colonial currency, before it was even the United States, was paper money issued by the colonies. And then I think that's right when we got banned by this guy, because he responds, the first money on U.S. territory for purposes of tax payment was tobacco, and most certainly not issued by the government. You are historically illiterate. And at least the other guy, the Satortionist, writes back, and when the government stopped accepting it, it stopped being money and faded into barter. I had a response typed up, but I was already blocked, and I wanted to talk about what that response would be. And I think it's interesting to look at this time period when tobacco was supposedly used as money. And I was vaguely aware of this, but I decided to dig into some articles about the history of this. And it turns out that in the original colonies, Britain, first off, forbade the colonies from issuing their own currency. Some of them did, like Massachusetts, anyway. But they forbade the colonies from issuing their own currency, and they didn't provide any currency or enough currency to the colonies so they could trade with themselves to begin with. So the colonies now have a situation where they can't make their own money, and the person who does make, or the institution that does make the money, won't give them any to work with. So what do? Well, tobacco. Okay, let's barter tobacco. Well, was it really barter? So I found this article
right back
on worldhistory.org. I'm going to pull it up. So this is a big article about the tobacco and colonial American economy. And it talks about a lot of different aspects of it. And I mean, basically, like Jamestown was the first, I think, successful colony in 1607, that even Jamestown, right at the beginning, they're growing tobacco. So tobacco is really, really important to the early economy of not the United States, but the colonies. And when you scroll down to tobacco and economy, so as the colonies prospered, they attracted more immigrants from England and elsewhere. Colonial governments had already established, now oversaw further development of land and creation of roads, shipbuilding business, and a booming economy. The colonial American economy was fueled by 8 steps, which depended on the tobacco crop. First, the farmers grew the tobacco. It would be harvested. It would be dried. Now, the colonial authorities would then inspect it for quality. So there's your first level of government coming in to say, okay, is this tobacco the tobacco that we're saying that is worth that you could pay taxes with? Then step 5, inspectors gave the farmer a writ for a certain amount based on the quality of their tobacco, quality and quantity of tobacco. And step 6 has it all. The farmer would use this writ to purchase goods from local merchants. Here's the most important part. And here's where it gets confusing, but ultimately it leads to the state theory of money, similarly to what we talked about ancient Sumeria. Like, okay, they used grains to measure their money, therefore the grains of barley and wheat were the money. No, that's what they initially measured it by, but what the money was the writ. The farmer would use the writ, aka a tobacco note, to purchase goods from local merchants. So the writ was the thing. The note was the thing that circulated as money, not the tobacco. And they were put specifically in this situation because the head authority, which was the government of England, forbade the colonies from making their own currency and did not provide enough currency for the colonies to run their own economies. So they had to come up with something, and this was the workaround that they came up with.
By the way, it is actually another case for credit money in a sense.
That's that's the argument I'm making. Yes.
Yeah, because there has been historically even we don't necessarily talk about this a whole lot, but there's a whole a chapter of private credit money, and David Graeber, for example, in his book Debt: The First 5,000 Years, writes about how that has been more common in the Islamic world, for example, where the best and most trustworthy merchants would be able to issue bills that would entitle you to some of their goods. So now these bills would circulate among the less trustworthy merchants, I guess, for convenience sake, but every one of them could go back to the big merchant and exchange the bill for some goods or services of some value. What Graeber also describes in that book is that these kinds of credit systems, they can work, but they can also get very shaky. Now, I'm not going to say that these systems are not workable, these private credit systems. Actually, this might be a possible private money system down the road in future, right? If we, but a different topic. What Graeber talks about is, okay, let's say you have a cobbler, and his name is Henry, and he gives you a note that entitles you to a pair of shoes from cobbler Henry, right? So now, or something like a pair of shoes is, and by the way, another stipulation that he puts in, right? So now we have subjectivity coming in, right? What's something like a pair of shoes? But anyway, the cobbler Henry says you're entitled to something like a pair of shoes. That bill will trade at a big discount, and the holders of it are going to be kind of sort of scared of future implications. What if Henry dies or can't produce shoes anymore? Now imagine it's not the cobbler Henry, but it's King Henry, and he has the power of a government apparatus behind him that can collect money and tax people. And he tells you, this bill frees you from taxation for the amount of this bill, for example, right? I will extinguish your tax liability if you present this bill. Now it's a very stable currency that circulates, right? And people have more future planability and certainty.
I want to take the idea that you just said and really emphasize that. I just found this perfect article here. This is from Time Magazine talking about exactly what you said, which is there's tobacco and then there's things kind of equal to tobacco. Let's just read the first two paragraphs here, and I think you'll understand what we're saying. So, early American colonists had a cash problem. Here's how they solved it. Money, or lack thereof, was a persistent problem in colonial America. The colonists were under the control of Great Britain, where the legal tender was both gold and silver, known as a bimetallic system. Yet British coins circulated only rarely in the colonies. The colonists had an unfavorable balance of trade with the mother country, meaning that the value of the goods they imported from England greatly exceeded the value of goods exported back. So there's more money, there's more specie leaving the colonies than there is specie coming into the colonies from Great Britain. Most specie that flowed into the colonies through trade quickly flowed back to England in payment for these goods. Nor did the colonists have access to specie through any domestic gold or silver discoveries. In order to have a functioning economy, the colonists were forced to turn to other commodities for use as money. Spanish coins, from trade with the West Indies and Mexico, circulated freely in the colonies as legal tender. While goods were officially valued in British pounds, in their day to day transaction, colonists more commonly used the Spanish dollar as their unit of account. I mean, this is like credit theory of money just exploding out of this, right? Even though they had to use this other thing, everything's still denominated in British pounds. The Spanish coin was known as pieces of eight, or the Spanish coin known as pieces of eight was the most common coin in the circulation throughout the colonies, but these were still too rare for the needs of the economy and were often exported as payment to England. From 1643 to 1660, wampum, the shells prized by the local Native American tribes, were legal tender in Massachusetts. This promoted the development of a colony by facilitating trade, but the British did not approve of this monetary system and ended the practice in 1660. This is what I was saying is these colonies weren't allowed to create their own money. Throughout the 17th century, colonists further south in Virginia and North Carolina employed tobacco leaves as commodity money. In an effort to address the problem of durability, they later substituted tobacco warehouse receipts for the actual tobacco. These receipts were like promissory notes. They recorded the value of tobacco stored in the warehouses for later sale. Since the bearer of the receipt had a claim on that exact amount of tobacco, the receipts circulated like currency.
Yeah.
A perfect example of how the barter system immediately doesn't work, and they have to switch to something else.
And
Yes.
and also another thing that comes to mind is because to promote or support this barter theory of money, historically economists have referenced certain trade. I think Adam Smith does it in his book. He says that there's been trade by certain tradesmen in England who would trade nails in exchange for fish or something like that.
Mm-hmm.
And I think Graeber points out in other MMT, or maybe some other MMT pointed out, maybe Randy Ray in his book, I don't know, that these were people who had predictable shipments of nails, right? You know, if you're like a blacksmith, you have so and so much nails in output regularly, so you can sort of deliver nails in exchange for food or whatever you need. But at the end of the day, they would always the decision of, okay, how much bread do I get for my for 500 nails? That would all be referencing the country's monetary unit once again. So they were actually using the existing monetary unit,
Even if they didn't have the coins.
exactly, because there was a
Yes.
dearth of coin there. Same situation as well in some periods. So yeah, they would just on paper calculate, okay, nails are worth so and so many pounds and bread is worth so and so much pounds. Okay, so we'll exchange 500 nails for a loaf of bread. So yeah, you see superficially at times you see people trading goods, but they are still doing it with the help of the existing fiat monetary, overarching fiat monetary system. They're doing it within the context of that system. They couldn't do it without that unit of account, in fact.
Right.
At
And
least
then
they
it
would
may
have
even be
to.
something, sorry to interrupt you, but let's say I get you the shipment of nails before you give me the shipment of fish, right? So now I gave you the shipment of nails. It's not that you owe me 500 fish, you owe me 500 pounds, and whatever the fish is worth, that's how much fish you owe me.
Exactly. So yeah, the barter theory of money is, sometimes. So even in the cases where in recent history it may look like barter has taken place on a bigger scale, there's really no such system in place. Now, obviously, we're not saying, nobody's ever traded their sugar for some salt with a neighbor or whatever, or things
Yeah,
like that.
barter does exist. We're just saying it doesn't run the economy.
Right. It's not an
Yeah.
economic system on any large scale. It does happen. It actually happens in fiat money economies probably way more than in primitive economies that don't have enough stuff to go around.
Okay.
So it does happen, but it always happens within the fiat money system. With maybe some, like I said, Graeber said there has been some exceptions of periods of universal warfare and breakdown of trust, where obviously this, out of necessity, this whole situation might change, but only because conditions are really rough.
Well, even in those periods of universal warfare and breakdown of trust, I mean, let's take the age of the colonialist empires or the great capitalist empires, whatever he called it in his book. In that, so what you said it was 1440 to 1971, closer to the 1440 side. This is getting right up to the point where the Spanish discover the Americas and start exploiting them for gold and silver, and there's this total wash of gold and silver now hitting the Western world. And we now enter this point of universal warfare. But what's going on in terms of this universal warfare in Europe is that China was on a silver standard. And so, one of the arguments is that, okay, Spain finds all this gold and silver, they start mining it and bringing it back to Spain, and they experience all this inflation in Spain, and that's obviously because they were just introducing too much currency. Well, what they're leaving out is all that silver, most of it ended up in China, because China was so silver crazy, because that was the fiat money in China, and most of the gold ended up in France, because the economic thinking at the time, and in E. Michael Jones' book, which I interviewed him about, he talked about this, and I can't remember who was the economic thinker that led to this, but there was this idea that money is wealth, and that goods and services aren't necessarily the wealth, and so let's just get as much money as we can.
Labor, right? Doesn't he say labor?
That's Dr. Jones' view. What he's saying, at this point in history, there was someone who came up with this idea that money is wealth. And the Spanish really grabbed onto that idea. And so they start importing all this gold and silver. And what France did is they said, okay, instead of focusing on getting the gold and silver, we're going to focus on creating industry. And because the Spanish didn't focus on creating industry, they had to go, shit, someone needs to make all this stuff for us. Hey, France, make this stuff for us. And so the gold went to France, so the stuff could come to Spain. And I think it's obvious, if all the silver is eventually making itself available in China, and all the gold is moving to France, but somehow Spain still experiences inflation, it's because they destroyed their productive capacity by focusing on let's get gold and silver, as opposed to focusing on let's make things.
Absolutely. Yeah. It's like a obsession with a metal instead of actually making stuff and
providing services.
Exactly. Yeah. So how do we get to this now?
I don't know, but it's been good.
no, I was wondering what else we have to cover regarding.
No, so, yeah. I mean, I think we could go forever if we just keep pulling up articles, but I think this is pretty good. Kind of, I guess taking a step back here, is we started off with this guy making this claim about MMT, which is whether it's true or false, we can't even get to, because a word concept fallacy is embedded into it. So we have to ask, what are you even talking about? Right. And boiling it down to, most people, when we think that when we promote MMT or when we criticize Austrian economics, they think we're criticizing the philosophy. We're challenging the philosophy. We're not challenging the philosophy. What we're challenging are the basic set of assumptions that the philosophy is applied to.
Yeah, in fact, I would say, ironically, if you understand MMT, you could get to your minimalist, minarchist economy, or even an ANCAP economy in a heartbeat. It wouldn't. All the obstacles that you think are in your way aren't actually real. So you could slash taxes to 1% universally in this country and keep the federal government at the same level of spending as it is right now, and then observe, okay, now we're experiencing inflation. Inflation is spiking up again because deficits are too large. Okay, now we can cut spending to where the inflation comes down to your liking, private sector, right? So this would really be, but the problem is they have it backwards. They always want to cut spending, and maybe
like they're doing in Argentina. Sorry.
Right. And then maybe cut taxes here and there. But the way to really make it happen would be slash taxes big time, and then you deal with the spending afterwards. Because if you just cut spending, you're going to reduce the private sector's income. You're going to piss off a bunch of people, and you're going to accomplish nothing because they will vote you out of office and they will hate you for the rest of eternity. And by the way, the entire ideology of libertarian economics will be hated for the next 100 years because everyone will go look back at that experiment that was done there. So,
hey, Nima, I
yes.
just realized I'm supposed to be on a meeting.
Okay. You are.
I was too excited about what we're talking about. I'm 7 minutes late. So this has been I Read a TV with Dylan and Nima. I think we covered a lot of good stuff. We'll edit this up and we'll post it up. Thanks for watching. We'll see you next time.